Looking at a record start to the month, all three of the major averages in the green, S7P hitting a new record high. We have full coverage for you. Kevin Nicholson, RiverFront's global fixed income co-chief investment officer, is with us. We also have Ed Egilinsky. He is Direxion's managing director and head of alternatives. And of course, Jared Blickery standing by with a closer look at some of these big movers into the close. Jared, let me go to you first, because we're seeing some buying here on the first trading day of April, with all three of the averages here moving to the upside.
That's right. And the action today has been centered in tech. We can see the Nasdaq 100 up 1.7%. Excuse me, this is a composite. Let's take a look at what's happening over the week. 2.54%. That's a nice add for the Nasdaq, which has been under pressure during various times this year. Also looking at the Dow, that is a laggard of the day, up 0.5%. Going to probably notch about 0.25% for the week. And if we drill down inside the Nasdaq 100 this time, we can see the mega caps adding to gains, except for Apple. Looks like Apple losing a little bit of steam here, but look at Alphabet. Alphabet up almost 3.5%, 21% year to date. And let's check out what it's done this week. Another 5%. Also, Facebook has been a gainer this week. That's up over 1%. Microsoft and Amazon up over 2%. Also, the chip space. Got to highlight this again, because after those Micron earnings yesterday, then followed up by that Biden speech on infrastructure, potentially $50 billion outlaid for the space. We're seeing a lot of dark green here. Applied Materials also up 5.5%. Lam Research up 7%. Probably going to see some more consolidation in the space. Now, we also have to take a look at the energy market, because that has been in focus since OPEC Plus finally met today and decided that they were finally going to raise production just a little bit, catching market participants off guard just a little bit. But we closed over $60 per barrel, and we're seeing some nice gains in the space as well. Exxon up over 2%, Chevron up 1%. And here is the closing bell on the first day of Q2.
All right, we got a closing bell. Curtain drops on the first day of trading on the second quarter. And as Jared just said, we had some winners. Let's take a look at where things are going to settle. Dow's going to be up about 0.5%. The S&P 500 is going to be up more than 1%, record territory, 4,019. Nasdaq up more than 1.75%. We'll keep an eye on that. Big sector winners today. Communications services up about 2%. Energy, Jared was just talking about that, up 2.5%. Sectors that lost, consumer staples down 0.25%, healthcare off 0.25%, and of course utilities, they were off about 0.25%. Let's go back to our guests, and I want to throw it to Kevin, because you've pointed out that the expectation is for revenue growth in the first quarter, especially as we're going to hear from the companies. We're going to get a whole new round of earnings. But is it possible that, I'm going to quote Moira Rose from Schitt's Creek, that people are counting their poultry before it incubates, that they're jumping the gun on this?
Well, I think that's what's happening is the market is pricing for perfection right now. And when I say perfection in the sense that we're going to have a smooth reopening of the economy, and that we're going to continue to have vaccinations go smoothly, and that we're not going to have any hiccups. But I think that, first quarter earnings are going to be good, and it's setting up that, there's momentum that's going into second quarter.
And what do you think of the leadership that we're seeing, at least for today? We're seeing tech back in favor.
Well, you've seen really schizophrenic behavior. You've seen a couple of days where the small caps have led this week, and the last 2 days tech. What we're seeing, especially with our short-term trading vehicles, in light of the infrastructure stimulus that is proposed, continues to be in our triple leverage industrials and transports. So from a short-term trading perspective, we're seeing money in the industrials and transportation. Also, as your guest said before, in the semis as well. SOXL is our biggest fund at Direxion. It's triple leverage semiconductors. It tracks very short-term trading vehicles, but we continue to see momentum there. Despite the fact that some people are thinking that with rates as high as they are now, albeit off of low levels, that areas like healthcare and tech and utilities might suffer if that rate rises continue.
Well, and I want to keep this discussion going, especially when it comes to infrastructure, because with the market as high as it is right now, and everyone anticipating big spending with infrastructure, but that's going to be a several month, perhaps even a year-long debate without a guaranteed outcome. Would you be buying at an expensive point right now, or would it be better to wait till we get more direction out of Congress?
Well, that's $1 million question. I think some infrastructure bill is going to get through. How big remains to be seen. So I think that has bipartisan support. Could you wait a little bit maybe and let the dust settle? Yes. But ultimately, I think those are areas to be in for the foreseeable future where there's opportunity. Also, let's touch on with the stimulus proposal, alternative energy as well as electric vehicles. And you're seeing those are catching a bid over the last couple of days. In fact, we just launched a hydrogen ETF this week, HJEN. That's seeing some flows in there, as well as our Moon ETF, which encompasses a number of innovative, disruptive companies that includes electric vehicles and alternative energy.
Kevin, after you heard President Biden's infrastructure plan yesterday, did that change at all your projections for yields, at least in the maybe not short term, because like Adam was saying, this is something that we might not get for some time, but maybe looking a little bit longer out?
No, it really hasn't. In the short term, I expected rates were going to be within a 25 basis point range in that 150 to 175 range. As we move further out in the year, I really don't see, yields crossing much higher than 2% this year. And the large reason for that is because I think that there is opportunity from foreign investors to actually pick up some incremental yield, both in Europe and Japan. Those investors can pick up anywhere from 100 to 115 basis points, and that's including the hedging costs. So I think that we're going to have some support as far as yields are concerned, as far as moving higher. So there's going to be a little bit of overhead resistance, I think, because you're going to get those buyers coming in as yields have moved higher here.
But Kevin, you also point out that in your terminology with the equities, they're going to grind higher because wages are not going to be going up, if I'm reading you correctly. Therefore, the demand or the spending we would want to come with that, not so much. Right, Kevin?
Yeah, I mean, from the equity perspective, equities are going to be dependent on how fast yields actually move up. And if yields don't move up, that quickly, I think equities will continue to grind higher. And when I say grind higher is because I believe that there are going to be some pullbacks. So when you go back from to March of 2020, when the market was at its lows, we've pretty much had a straight path straight up over the past year, with some very short pullbacks, very minor pullbacks in the market. And I think that going forward, we're going to see a lot more pullbacks, and they're going to be a little bit more volatile than we have seen over the past year. So that's why I think it's going to be a grind higher from current levels, because we are priced for perfection, as I said earlier.
All right, Kevin Nicholson of RiverFront and also Ed Egilinsky of Direxion. Always great to have you both. Thanks so much for hopping on here with us today.